Welcome to the deep dive. Today, we're getting into a really foundational work. It's Benjamin Graham's The Intelligent Investor. You probably heard it called the Investor's Bible. Warren Buffett himself said it's by far the best book on investing ever written. So, quite the endorsement. Our mission today is really to pull out the core ideas, the stuff that lasts. Forget the hype, the get-rich-quick schemes. We want to give you a shortcut to understanding the principles that actually work for building wealth over the long term. So what you'll gain is hopefully a better framework for making smarter decisions, protecting your money, and keeping a level head, whatever the market's doing. It's about mindset. Okay, so let's start with the basics. What is an intelligent investor, according to Graham? Okay, that might not be what you think. It's not about being a genius stock picker or predicting the next big thing. Graham really hammers this point home. It's about temperament, not IQ. So the key traits are discipline, being rational, and crucially, not getting swept up in market emotions, fear and greed, right? The focus is always long-term value, resisting that urge to speculate. And maybe most importantly, priority number one is protecting against serious loss, not just chasing the highest possible return.
Yeah, and so interesting because he flips the usual script, doesn't he? Most people think you need to be brilliant, maybe have some complex algorithm. Graham says no, it's emotional stability, a steady hand. That's far more valuable in the messy reality of markets. It's less about knowing the future, more about responding wisely to whatever is happening now. I mean, just think about the waves of panic and euphoria we see. It makes perfect sense why temperament is key. So it makes you think, right, are you cultivating that discipline? Or do you find yourself, reacting to the crowd? That's self-awareness. That's really your starting point, your first big asset.
Okay, so if temperament is so central, Graham then helps us figure out, well, where do we fit in? He gives us two broad categories of investors. And he's pretty clear that knowing your type is fundamental. You got to choose the right path. First up is the defensive investor. This is basically the passive approach. Think safety first, simplicity, minimal ongoing effort. Their portfolio usually leans towards high-quality bonds, maybe some diversified, large, stable company stocks. Capital preservation is the name of the game.
Safety and minimum fuss.
Exactly. Then on the other side, you've got the enterprising investor. This is the active type. These are the folks who are willing and actually able to put in significant time and effort. Real intellectual energy. They're actively looking for stocks that might be undervalued or overlooked by the market, doing their own research. Now, they accept more calculated risk, sure, but Graham draws a very sharp line. Pure speculation, that's out, always. Right. And this choice, defensive versus enterprising, it's not just a label, is it? It's really a foundational decision for everything that follows. Graham's point, I think, is that the most important step isn't finding the next Amazon. It's aligning your strategy with who you actually are, your temperament, how much time you realistically have, your skill set. Trying to be an active, enterprising investor without the time or discipline, that's just asking for trouble. So it forces you to be honest with yourself. Which path really fits your life? Getting that clear can save you a lot of pain later on.
Yeah, that self-assessment seems crucial. And speaking of market behavior, that leads us perfectly into one of Graham's most brilliant ideas, Mr. Market. It's such a powerful metaphor. He asks you to imagine the stock market as this business partner you have, Mr. Market. And this guy is, well, he's pretty eccentric, maybe bipolar. Every single day he shows up, rain or shine. And he offers to either buy your share of the business or sell you his share. But here's the thing. His prices are all over the place, based purely on his mood. Some days he's just bursting with optimism, totally euphoric. He'll offer you a ridiculously high price for your shares. Other days he's inconsolable, deep despair, and he'll offer to sell you his shares for peanuts. Just wants out.
Yeah, very moody partner.
Exactly. And the lesson for the intelligent investor is profound. You don't let Mr. Market's moods dictate your actions at all. You don't get giddy when he's optimistic and overpay. And you certainly don't panic and sell cheap just because he's depressed. Instead, you treat his offers as opportunities. When he's being irrational, you can potentially take advantage. The core idea, use the market, don't follow the market. You're in control, not him.
But isn't that incredibly hard? Just ignoring these wild swings, especially when everyone around you seems to be reacting.
It absolutely is hard.
Yeah, and that's where the genius of the metaphor lies, I think. It's not just a neat story, it's a psychological tool. A shield, almost. It gives you this framework for staying emotionally detached. So when the market crashes, you don't just see panic. You see Mr. Market having a really bad day, offering potential bargains. And when things are booming, you don't just get swept up in the hype. You see Mr. Market being maybe a bit too optimistic, potentially overvaluing things. It fundamentally changes how you see volatility. It's not a threat signal demanding an emotional response. It's just information, an opportunity for rational thought.
Rational action. That really flows into the next big concept, maybe the central pillar of value investing, the margin of safety. This is all about building a buffer, a cushion for your investments. Graham defines it simply as buying something for significantly less than your careful estimate of its real underlying value, its intrinsic value. So let's say you analyze a company and figure its shares are truly worth, I don't know, $100 each. An intelligent investor wouldn't just buy at $100 or even $90. They'd look for a substantial discount. Maybe they wouldn't touch it unless it dropped to, say, $70 or $75. That difference, that's your margin of safety.
Right, a 25–30% gap.
Exactly. And the effect is huge. It does two things. It lowers your risk dramatically, and it also increases your potential for better long-term returns because you've built in room for error, room for things you didn't foresee, bad luck, or just general market craziness. It's like leaving extra stopping distance when you drive.
Absolutely. It connects directly to prudence, doesn't it?
Yeah.
And actively managing risk, not just hoping for the best. That margin of safety, it acts like this protective barrier around your capital. By demanding it, your success becomes less dependent on being perfectly right about the future, which, let's face it, nobody is, and more dependent on just being disciplined and conservative about your entry price. It's Graham basically saying, look, unexpected stuff will happen, prepare for it. It bakes resilience right into your approach.
Okay, so being prepared, being rational, that brings us to another really key distinction Graham makes. It's one that gets blurred all the time in, popular discussion. The difference between investing and speculating. Graham is very clear, almost strict on this. For him, an investment is, and I quote loosely here, an operation that, after thorough analysis, promises safety of principal and an adequate return. Notice the keywords. Thorough analysis, safety of principal, adequate return. It's about a reasoned expectation of outcome.
Analysis is key there.
Definitely. Now, contrast that with speculation. Graham defines speculation as essentially buying something mostly because you hope the price will go up, without that deep fundamental analysis. He wasn't saying speculation is inherently evil or anything, but he warned very strongly that you absolutely must keep it separate from your serious investing activities. Treat speculation more like, entertainment. Like going to Vegas. Use money you can truly afford to lose completely.
And keeping that line clear is just vital, isn't it, for building actual wealth over time. When you start confusing the two, that's when big mistakes happen, because you start making decisions based on hope or hype rather than on solid analysis and value. Graham's point is that real financial security, that steady growth, it comes from disciplined work, not from gambling on price swings. It's about building something solid, brick by brick, not chasing lottery tickets.
Building something solid. And a big part of that foundation, maybe the biggest, according to Graham, isn't about the assets themselves. It's about us, the investor. He believed the main risk usually comes from our own behavior, our own emotions. He taught that market downturns, crashes even, they're inevitable, just part of the cycle. But the intelligent investor, they stay calm. They see these downturns not as disasters, but as potential opportunities to apply those principles we talked about, like margin of safety. And here's a really key insight, almost counterintuitive. Graham felt emotional discipline is actually more important than sheer intelligence for long-term success in investing.
Right. More important than IQ points, which is fascinating. And, it's easy to say be disciplined, but we all know how hard that is in practice. Graham really understood those psychological traps we fall into. That herd mentality, wanting to buy when everyone else is buying, sell when everyone's panicking. Resisting that urge, overcoming the fear, controlling the greed. That's not a one-off thing. It's a continuous practice, a discipline you have to cultivate constantly. Honestly, mastering your own emotions when the market is going wild, that might be the single biggest return you can achieve, because it allows you to act rationally when most people are acting emotionally. That's your edge.
Okay, so we have these core principles: temperament, knowing your type, Mr. Market, margin of safety, separating investing from speculating, emotional discipline. How do we put this into practice? How do we actually build a portfolio based on this? Graham gives some pretty concrete advice here, too. First, he talks about inflation, that silent killer of purchasing power. He points out that while bonds are generally safer in terms of price stability, they're quite vulnerable to inflation eating away their real value over time. Stocks, though, despite being more volatile day to day, they've historically done a much better job of protecting purchasing power against inflation in the long run. So managing risk involves diversification, Don't put all your eggs in one basket. Spread investments across different industries, different types of assets. And to handle that volatility and avoid the trap of trying to time the market, he strongly recommends dollar cost averaging, which just means investing a fixed amount of money at regular intervals, say, every month, regardless of whether the market is up or down, smooths out your purchase price over time.
Yeah, takes the guesswork out of when to buy.
Exactly. Now, for picking actual stocks, he has guidelines based on investor type. For the defensive investor, the advice is pretty straightforward. Stick to large, prominent, financially sound companies. Companies with a long history of continuous dividend payments are good. And actively avoid growth stocks that are currently hot or fashionable. Avoid the hype. Focus on stability. For the enterprising investor, though, it's more hands-on. They're the ones actively hunting for bargains. They look closely at metrics like the price-to-earnings ratio, comparing price to book value, checking for consistent earnings, dividend records. But the crucial element here is patience. They only buy when they find a truly compelling opportunity based on their analysis. They don't just buy for the sake of being invested.
And what's really neat is how all these practical steps, thinking about inflation, diversifying, dollar cost averaging, those stock selection rules, they all tie back perfectly to those big principles. Safety first, long-term thinking, emotional control. Together, these strategies build a portfolio that's designed to be resilient, to withstand the inevitable bumps in the road. It's about steadily accumulating wealth over time, not chasing those quick, often illusory gains. It's a blueprint for durable investing.
So wrapping this up, what's the big takeaway from The Intelligent Investor? I think the core message is really clear and honestly timeless. Successful investing isn't really about outsmarting everyone or beating the market year after year. It's much more about consistently avoiding major errors. Focusing on steady, adequate returns over the long haul, it really comes down to applying these principles: margin of safety, discipline, diversification, and crucially, controlling your own emotions. That's how you protect your capital and build wealth gradually but surely.
Could agree more. And that Buffett quote just seals it, doesn't it? By far the best book on investing ever written. Its relevance just doesn't fade. So as you think about all this, maybe a final thought to consider. Which of these big Graham ideas, Mr. Market's mood swings, the cushion of the margin of safety, or that constant battle for emotional discipline, which one feels like the biggest challenge for you personally? Or maybe which one feels most intuitive? And how might really focusing on mastering just one of these insights change how you approach building your own financial security for the long term?